It's fascinating to compare asset classes. What silver is to gold is exactly the same what Ethereum is to Bitcoin. It seems like the assets have nothing to do with one another. Bitcoin is a store of value, Ethereum is a smart contract platform, silver is an industrial metal, gold is a store of value, yet the assets tend to trade in the same direction at the same time. It seems like it's the same kind of investor that buys gold and silver versus the one that buys Ethereum or Bitcoin. What we see over here, that's the gold price in yellow and the silver price in white. Silver has seen a massive rally recently, but in general, the two assets tend to either both go down or both go up. Now what we've got over here, that's the gold to silver ratio. How is gold outperforming silver? The dotted line, that's the average ratio since the beginning of that chart, which started in 1931. So that's almost 100 years of data. Now some people call for silver to continue to outperform, as in there might be a 15:1 ratio of silver versus gold again. I have my doubts though, because we've already overshot the long-term average. Now this is 100 years of data. I don't know what your time horizon is, but this is long enough of a data set for me. Now this chart here starts 66 years ago. This is where we got the data set for the US money supply. This is the gold price relative to the US money supply. It's important to understand where gold might be headed from here, because of course there is a spillover effect towards silver. Gold and silver is not the same, but they are traded as if they were, as we've already shown at the beginning of the video. And so gold historically is above its average ratio to the US money supply by roughly 68%. If you were to come back to that potential equilibrium price, we might see gold fall by 40% versus the monetary base. Now, the monetary base never really falls. This here is USM2, the money supply. It grows by 6.8% per annum. This is a linear scale. Here we've got the same on a logarithmic scale. The declines, if they ever happen, are very, very short-term and rather insignificant. And so is this potentially the end of the gold rally, since we've already seen a turnaround point at very similar price levels in the past? Yes, at the beginning of the 1980s, we did have higher gold prices. But is it really reasonable to assume that this is going to be the next price target? The current momentum will continue until we hit those levels again. Had you invested in gold at the beginning of the 1980s, then compared to today's money supply, you would be down by 62%. So if you're buying gold at the wrong time, you might never really recoup your purchasing power. Again, if you're measuring purchasing power just in terms of monetary devaluation, not necessarily in terms of consumer goods, right? Consumer good price inflation is lower than 6.8% per annum, but that's because we become more and more productive at producing consumer goods. If you just look at how much is the monetary base devaluing, and 6.8% is, I think, the best measure. Now here's something interesting. Again, remember those 62% underperformance. How much does gold expand per year? There are companies specialized on gold mining. And while this is here the quick answer that I got through AI, this is also what I read about in the past in various articles. The gold supply grows by roughly 2% per annum. Now from this data point over here to this data point over here, we've got 46 years. Let's compound 2% per annum of potential loss of purchasing power by 46 years. We have left over 39% of our initial capital, or we lost 61%. Pretty much exactly the value that we get comparing those two price peaks. Or in other words, those two tops might be aligning perfectly if we were to compare market caps, not prices. Because unfortunately, I don't have the gold market cap data in TradingView. I only have the gold price. So we're comparing the gold price with the market cap of fiat currencies with USM2. But if we were not to do that, if we were to compare market caps directly, those two peaks would align perfectly. If you're enjoying this video so far and you're getting some value out of it, then feel free to give this a like. It will help the channel grow. It will help spread the word. Thank you very much. And so maybe this horizontal line here is already too optimistic. Maybe we should rather draw something like this, because this now shows how much gold might be underperforming a theoretical constant money base. By the way, this is a logarithmic scale. So those two tops align quite nicely. A lot of the tops and the bottoms here also seem to align relatively well. So now the picture really doesn't look that great anymore. And that's for gold. And again, in terms of at least medium-term trading, gold and silver trade relatively similarly. So when Bitcoin is going up, at some point when people made enough profit, they might shift over their capital from gold to then Ethereum. So maybe this is what's going on here with silver. Many people made money with the gold run, and so maybe a lot of profit is taken from gold because the upside for gold might not be as high and is now shifted towards silver. And at some point, the market is getting so hot that everything comes crashing down at the same time. We have seen this in crypto. We've also seen this for longer term cycles in precious metals as well. Because that's where the precious metals market and the crypto market is different. The cycles here take decades. They don't just take a few years. So missing a potential exit opportunity is not an error we can correct within 4 years when the next cycle comes. It's an error that might get corrected by our children, who then inherit the gold, who then 30 years later decide to use that purchasing power again. And so really that's the problem here. Gold is not anymore historically cheap. Could it potentially go up much higher if the global financial system implodes? Yes, of course it could. It's still the only self-custodied asset that's very easily accepted in pretty much any part of the globe. Maybe there's also Bitcoin, but Bitcoin is more volatile. Bitcoin is still traded like a risk-on asset. When all assets are crashing, Bitcoin will come down as well. That's not necessarily true for gold. So gold is a good insurance policy against the ultimate crash, but it's not necessarily a great diversifier in a portfolio right now, given the high valuation. But what about silver then? Here is not the gold to silver, but the silver to gold ratio. Does it really make sense to take on that much more risk when there's maybe potential outperformance of 75% or so, and then that price peak has to be timed perfectly? Here's probably the best approach. A trailing stop loss. This is just the silver price. And interestingly enough, this here is already a logarithmic chart. On a linear chart, this looks even more steep. So even on a logarithmic chart where we change at constant rates in percent vertically, we see that the relative growth also accelerated. So this is an ever accelerating price rally, also potentially known as a bubble. Yes, I dare to say it. I do believe that silver is currently in bubble territory. That doesn't necessarily mean that the price has to come crashing down tomorrow, but what it does mean is that it's not necessarily a value play anymore. It's rather a momentum play right now. So maybe something like a trailing stop loss might make sense here. As the price rises, we just adjust the stop loss, and then if at some point the momentum turns around, because all of that speculation on the perpetual futures, all of that speculation in the derivatives market suddenly collapses, then it probably makes sense to exit silver as well. There's a lot of inherent leverage in this rally, and that leverage will at some point unwind as well. We already see how physical silver prices are higher than perpetual futures prices. So the derivatives market is extremely heated right now. There's a lot of demand coming from short-term speculators, not necessarily from people that just buy silver in order to use it for production or in order to use it for long-term investment physically. Silver now has a larger market cap than Bitcoin. It's got a market cap of 4.5 trillion. Bitcoin has 1.8 trillion. And for the fun of it, let's just compare the silver price with the Bitcoin price. It has been trading in a somewhat constant range over the last 4 years. And the potential downside of 70% versus the potential upside of 30% is probably not worth it. When we zoom out, then of course silver did underperform Bitcoin long term. That was because Bitcoin was just on this massive rally through an adoption curve as an alternative to a gold investment or to a tech investment. It's traded rather like a tech investment. Can silver hit $100? Yes, definitely it can. Could this bubble continue bubbling up even more? Yes, of course it could. But I don't think that those prices will be sustainable. Gold looks expensive relative to its average ratio to the money supply. It also looks expensive relative to potential resistance. It looks even more expensive if we include the debasement of gold or the gold mining. And silver does trade in line with gold. It's similar kinds of investors that buy gold and that buy silver. Let's enjoy the momentum while it lasts, but but let's not get wrecked and forget to exit this bubble at some point. This is where most people get burnt. They believe the new narratives that are now floating around, and narratives and attention shifts over time. Maybe we are lucky and it will shift towards crypto again. But of course, nobody knows. I think that this potential underperformance of silver versus Bitcoin will mainly be silver going down, not Bitcoin going up that much. If you got some value out of this video, feel free to give this a like and potentially share this with a friend that's also invested in precious metals. Subscribing is of course also an option. I publish videos regularly on this channel. See you next time. Cheers.